Entrepreneurship capital markets. Capital markets. Capital markets are markets that trade in long-term financial products known as securities, e.g., shares, bonds. They are a facility for raising long-term capital, which is done through the selling of debt, bonds, commercial paper, and equity instrument shares. They provide avenues for those who require additional capital and others who wish to invest their money. Key players in capital markets. Different people, groups of people, or companies play different roles on the stock exchange. The roles of each are very vital in the smooth running of the market. Some of these players include the following. Different people/groups/companies play different roles in the stock exchange markets as explained below. 1. Brokers/dealers. These are licensed financial professionals authorized to buy and sell shares on behalf of their clients. Brokers execute trade deals on behalf of their clients and receive a commission for matching buyers and sellers. Dealers buy shares and later sell them for a profit. They also provide advice to their clients on management of investment. Dealers can be bulls, bears, or stags. A bull is a dealer who buys shares when they are cheap, hoping to sell them when the price rises. A bear is one who sells shares when prices are high, hoping to buy them back at a much lower price to make profits. A stag is one who deals in new issue shares issued by the company. 2. Registrar. This is a person in charge of keeping records in respect of stocks and shares of a floated company. A floated company is one which goes public by issuing its shares for sale. 3. Investment advisors. These are licensed persons who advise their clients about the profitability of selling and buying securities. They also manage a range of investments under a contract or on agreement with investors. 4. Shareholders. These are individuals or companies that purchase shares in a company or business and own a part of the company. They earn dividends for the shares bought. 5. Capital Markets Authority (CMA). This is a government-established body which ensures the regulation and development of capital market industry. The capital markets industry in Uganda is regulated by the Capital Markets Authority (CMA). CMA was established in 1996 following the enactment of the Capital Markets Authority Act Cap 84. It is an autonomous body responsible for promoting, developing, and regulating the capital markets industry in Uganda with the overall objectives of investor protection and market efficiency. Objectives of Capital Markets Authority. Functions of the Capital Market Authority in Uganda. Minus to regulate and promote the development of capital market in Uganda. Minus to approve stock exchange and securities central depository system. Minus to license brokers or dealers, investment advisors, fund managers, and trustees. Minus to approve collective investment schemes. Minus to advise government on rules and regulations governing operations of capital market. Entrepreneurship capital markets. 6. Fund managers are companies who, under a contract of management with a client, undertaking the management of a portfolio of investments. Portfolio refers to the funds managed on behalf of clients at the discretion of a fund manager. 7. Custodians. These perform the actual role of holding or safekeeping assets or securities, including cash on behalf of the owners, investors. Products/instruments in Uganda's capital markets. Capital markets use different instruments to raise capital, which include the following. 1. Bonds. A bond is a long-term debt instrument that is used to borrow a stated amount of money for a fixed period of time and gives a stated rate of interest, or it is a debt or loan instrument issued by the government or corporate body that carries a fixed rate of interest and with a maturity of longer than 1 year and gives the holder claim on the interest and principal promised by the issuer. Or it is a borrowing arrangement in which the issuer makes an obligation to pay back interest and principal at specified times and intervals. Maturity date. There are 2 types of a bond, namely, government bonds are issued by the government to borrow a stated amount of money from the public for a fixed period of time at a stated rate of interest. Corporate bonds are bonds issued by private or public companies that wish to borrow a stated amount of money from the public for a fixed period of time at a stated rate of interest. Features of a bond. It has a maturity date. It is a period of time over which the bond contract is extended, at the end of which the bond contract expires. It has a bond coupon. It is the periodic interest paid on a bond the issuer to the bond holder. It has a principal. This is the fixed period value of the bond initially paid by the creditor when buying the bond and paid at the maturity date. It has name of the lender. It includes name of the borrower. NB. Treasury bills. These are short-term financial instruments issued by the government to raise money from the public with a maturity date of less than 1 year. 2. Shares. A share is a unit of ownership in a limited liability company and gives the holder claim over any dividends that the company may pay, or it is a unit of capital of a joint stock company. Shareholders become part of the company where they have bought shares. 3. Debentures. A debenture is a unit of a joint stock company, or it is a document or certificate issued by a company evidencing that it has borrowed a specified amount of money from a named person and promises to pay back the principal with interest rate at that maturity date. Types of debentures. Naked debentures. These are debentures which have no security or property declared against them. This means that if the company fails to pay, the debenture holder has no powers to take over the company's property or to suit it. Major players in capital. Broker/deal. Entrepreneurship capital markets. Secured/mortgage debentures. These are debentures which have security tied to them, i.e., if the company fails to pay, the debenture holder can sell off the company's property to recover the loan. Redeemable debentures. These are debentures that can be paid back by the company after a specific period of time, i.e., the money borrowed is returned by the company within a given period of time. Irredeemable debentures. These are debentures which are never paid back by the company until it is liquidated or ended, i.e., the money borrowed remains outstanding or unpaid until the company winds up. 4. Commercial paper. This is a short-term unsecured promissory note issued by a company or even a bank with a shorter-term maturity date, usually 1 to 9 months, indicating a promise by the issuer to repay the amount borrowed against it on a specified date with a specified rate of interest. Commercial papers are usually issued by large companies or banks to get money to meet their short-term debt obligations and are not backed by collateral security. Role of capital markets. 1. Providing market to shares being sold. Capital market for shares being sold, hence enabling companies and individuals to buy such shares. 2. Improving on people's standards of living. People who buy shares get dividends, which increase their income levels and hence improve standards of living. 3. Providing employment opportunities. Capital markets provide jobs to dealers/brokers, registrar of companies, and investment advisors. This enables them to earn a living. 4. Encouraging inflow of international capital. Capital markets enable investors from abroad to invest their capital in the country by buying shares being floated or sold. 5. Providing revenue to the government. Capital markets provide revenue to the government in form of taxes imposed on them. 6. Promoting investments. Capital provide technical advice to investors, identify investment opportunities, and encourage people to save through buying shares, hence increasing investment levels. Advantages of capital markets. 1. They provide market to shares being sold. Capital markets provide market for shares being sold, hence enabling companies and individuals to buy such shares. 2. They improve on people's standards of living. People who buy shares get dividends, which increase their income levels and hence improve standards of living. 3. They provide employment opportunities. Capital markets provide jobs to dealers/brokers, registrar of companies, and investment advisors. This enables them to earn a living. 4. They encourage inflow of international capital. Capital markets enable investors from abroad to invest their capital in the country by buying shares being floated or sold. 5. They provide revenue to the government. Capital markets provide revenue to the government in form of taxes imposed on them. 6. They promote investments. Capital provide technical advice to investors, identify investment opportunities, and encourage people to save through buying shares, hence increasing investment levels. Objectives of promoting capital markets. 1. To provide market to shares being sold. Capital markets provide market for shares. Entrepreneurship capital markets. 3. To provide employment opportunities. Capital markets provide jobs to dealers/brokers, registrar of companies, and investment advisors. This enables them to earn a living. 4. To encourage inflow of international capital. Capital markets enable investors from abroad to invest their capital in the country by buying shares being floated or sold. 5. To provide revenue to the government. Capital markets provide revenue to the government in form of taxes imposed on them. 6. To promote investments. Capital provide technical advice to investors, identify investment opportunities, and encourage people to save through buying shares, hence increasing investment levels. The stock exchange is where already issued out share or securities are formally traded and sold, or it is an arrangement through which the already issued out shares are traded. In Uganda, they are traded under Uganda Securities Exchange. The Uganda Securities Exchange. This is the marketplace in Uganda where securities are traded. The Uganda Securities Exchange use was licensed to operate as an approved stock exchange in June 1997 by the CMA. The use began formal trading operations in January 1998 following the listings of the first instrument, the East African Development Bank EDB bond. The basic function of use is to provide a facility for raising funds for investment in long-term assets and is regulated by the CMA. Functions of stock exchange. It provides ready market for shares already issued out in the primary market to be transferred. Women 2 stock exchange market facilitates low-income earners to save in order to invest in companies listed on stock exchange. Women 3 stock exchange market helps companies in need of long-term finance to raise the required finances through selling their shares to the public. Women 4 creates a means through which natives of a country can attain ownership in various companies, especially to privatized companies. Identifying investment opportunities through capital markets. Investment refers to purchase of assets that are used to generate more income or financial gains. The capital markets industry offers various avenues for saving and investments covered below. Types of investors. Private investors. These are people who hold securities for their own benefit in terms of either interest on lent funds or dividends on shares. They tend to hold a small percentage of shares in a list company. Corporate investors are companies that hold shares in other companies for their own benefit. Entrepreneurship capital markets, either during the offer period or from existing shareholders. New issues of shares take the form of initial public offerings (IPOs), where shares are sold in a primary market. The IPO refers to the first time a company offers its shares to the public. To buy shares. The process is steps taken as discussed below. Steps taken in buying shares. 1. Finding and contacting the broker. The buying process begins with finding and contacting a stockbroker and the services he/she offers. This helps the buyer to find out whether the broker has the type of shares he/she wants. 2. Deciding on the type of shares to buy. The buyer decides on the type of shares and the company from which to buy shares depending on its financial performance and future prospects as advised by the broker. 3. Deciding on the price and number of shares to buy. This involves deciding on the price to pay for each share and number of shares to buy after getting the prevailing market prices of shares. 4. Placing an order. After guidance by the broker and making a decision on the type of shares to buy. The buyer issues a market order or a limit order to the broker. Market orders are simple buy or sell orders that are to be executed immediately at current and best market prices. The limit orders, on the other hand, are those in which investors or buyers specify the price at which they are willing to buy shares. The investor or buyer is supposed to fill 1. The Security Central Depository account opening forms. 2. A client information form. 3. An order form and also signs a purchase transfer form. 5. Receiving a copy of the prospectus. A prospectus is a legal document that gives general and material information on the company's history and operations or performance. The intending buyer receives this document and takes time to read it carefully. 6. Paying for the shares to the broker. The buyer makes for payment of the shares to the broker and in turn gets a receipt from the broker who then delivers the payment to the clearinghouse on the settlement day. 7. Receiving a contract note. This is a document that spells out the number of shares bought, the price at which they are bought, amount of commission to pay to the broker, details of government taxes which include the contract stamp, transfer duty and capital gains tax, and the total amount which the investors or client owes to the broker, which has to be paid on the settlement day indicated on the contact note. It is a legal document that acts as proof of ownership of the shares until a share certificate is issued. Payment of the total amount. This involves paying the total shown on the contract note on the settlement day. 8. Receiving the share certificate from the registrar. This is a document issued to a person as evidence that he/she has bought shares of the issuing company and therefore has claim to the dividends on the shares indicated on it. Entrepreneurship capital markets. It is a source of income to shareholders in form of dividends. When a company that issued shares makes a profit, the board of directors gives a percentage of the profit to its shareholders' dividends. Roman 2. It increases the value of capital. When shares are sold at a price that is higher than the price at which they were purchased, this represents a profit called capital gain. Roman 3. Investing in shares gives shareholders voting rights. Shares give a shareholder the right to attend and vote on important company decisions at the company's annual general meetings. Women 4. Shares act as collateral securities. Share certificates are used as collateral securities to obtain credit facilities like loans, credit supplies, etc. These shares are transferable. Shares can be passed on from one person to another and can also be inherited. Disadvantages of investing in shares. It results in depreciation in the value of investment. Share prices sometimes fall due to changes in demand and supply conditions or when a company's performance declines. Roman II shares are not freely transferable in private limited companies, hence limiting transfer that the holder has funds to other new priority areas due to failure of selling the shares to another interested person. Roman III decisions are made on the basis of rule of the majority in the annual general meetings. Hence the minority shareholders with contrasting and opposing views are not treated fairly. Roman IV shareholders, especially in public limited companies, lack direct control over their investments or day-to-day activities of the business. It leads to fluctuation in the value of share capital. This is due to fall and rise in prices of shares. Roman VI, if the company goes into liquidation, shareholders are the last to be paid after all other creditors and debtors. Investing in bonds. A bond is essentially a loan an investor makes to the issuer of a bond. The investor receives regular interest payments on the loan until the bond matures or is called, at which point the issuer repays you the principal. Certain bonds have special provisions. Bond funds pool money from many investors to buy individual bonds that meet the fund's investment objective. Most bonds pay regular interest until the bond matures. How bonds work. Bonds have three major components. The first is the face value par value. This is the value of the bond as given on the certificate or instrument. It is the value the bondholder will at maturity unless the issuer defaults. Investors pay face value when they buy the bond at its original face value, and the price may be more or less than the par. Entrepreneurship capital markets. Example. A typical bond company issues SHS 300,000 10-year bond with a 6% coupon rate. Each year, the owner receives SHS 18,000, 6% of SHS 300,000 paid in 2 semi-annual installments of SHS 9,000. Advantages of investing in bonds. Bonds are predictable. You know how much interest you can expect to receive, how often to receive it, and when the bond's face value will mature. Roman II bonds are steadier than stocks, which can fluctuate in short term. Some investors prefer bonds to equity investments since they are less volatile. Roman III people on a fixed income and retirement will receive a predictable amount of regular income from bonds. Most bonds pay interest to bondholders on a regular basis, with the exception of zero coupon bonds. Roman IV, the interest rates paid by bonds typically exceed those paid by banks on savings accounts, especially short-term bonds. Disadvantages of investing in bonds. Bonds lose value most especially when companies and municipalities go bankrupt. Roman II long-term bonds tied up money in low-yielding bonds. Roman III, unlike stocks, bonds don't offer the possibility of high long-term returns. Investors and those with several years to go until retirement would be better served by limiting their bond purchases and opting for equity buys instead. Roman IV, although bonds are less volatile than stocks, they are not immune from price fluctuation. Bonds from risky companies can be very volatile. It is also possible for a company to default on bonds issued, hence a loss of principal for the bondholder. Collective investment schemes. This is a type of investment scheme that involves collecting money from different investors and then combining all the money and investing in various products or private financial arrangements that pool together resources of many small savers, generating a large pool of resources which is managed professionally and invested in various assets such as shares and bonds with the purpose of making profits. It may also be called a mutual fund. There are two types of collective investment schemes. Unit trust schemes. These are types of schemes where investors buy units, which represent the various holdings of the scheme. One's investment is represented by the units they hold in the scheme. Roman II. Investment companies with variable capital where one's investments are represented by the shares they hold. The scheme takes the form of an ordinary company. However, unlike other companies, it is allowed to buy back shares when an investor wishes to pull out. Advantages of investing in collective investment schemes. Entrepreneurship capital markets. Roman III, it lowers transaction costs. By investing in CIS, investors incur lower costs than if they were to buy and sell bonds directly. This is because transaction costs are generally Related to the size of the transaction, and investors benefit from the fund manager's ability to deal in large quantities of shares at lower average dealing costs. Roman 4, they promote professional management. CISs provide full-time professional management in a direct and simple form, and this is especially important where market information is not widely available. V, it protects investors. People need to have confidence that their money is protected from fraud, thieves, and other abuses. The CIS Act and regulations made under it provide the desired regulatory framework that will protect investors in Uganda. Roman 6, it makes liquidity easy. It gives an opportunity to easily liquidate investments by selling your units back to the manager. Disadvantages of collective investment schemes: says I loss of control/ownership rights. When you invest in CISs, you are not involved directly in deciding how your money is invested. As long as the unit trustee manager invests your money in a scheme, there is little that either unit holder can do if you disagree with their investment decisions. The unit trust fund managers are more likely to make right investment decisions than small investors. Roman 2, it leads to high operational costs due to fees and charges. The services provided by the fund managers are not free. There are fees and charges paid by the unit holders to the collective investment schemes. Collective investment schemes purchase process. I going to Unit Trust Manage African Alliance Workers House Floor 1. Roman 2, filling in an account opening form. Roman 3, selecting the type of unit trust account, short-term or long-term. Roman 4, depositing money on account given. B, sending copy of deposit slip to African Alliance. Roman 6, you become a unit trust account holder. Raising long-term finance through capital markets. Many businesses struggle with financing, especially long-term financing. Questions arise as to how to expand a business. Advantages of raising long-term finance through capital markets. Raising funds. Through the sale of shares on the capital markets, businesses are enabled to raise funds. Unlike in commercial banks, interest rates may be very high, security required, and others. But in capital markets, the raising of funds is cheaper, easier, and faster. Roman 2, provision of market to sell and buy shares. They provide members of the public or company a chance to buy shares. This provides them an alternative method of investing their savings. They can also sell their shares in case they would like to opt out of the company. Entrepreneurship capital markets. Roman 4, better standards of living. A well-organized increased investment by companies due to the existence of capital market will lead to more employment opportunities being created, more income generated, and more disposable income that people may use for consumption and saving. Thus, people's standards of living are expected to increase. Avenues of rising long-term financing through capital markets. There are 2 avenues for raising finance through capital markets. Equity financing. Here, the business raises finance by issuing shares to the general public. Those who buy shares of the company then become part owners of the company and hence shareholders. However, a company should first apply and then seek approval from a CMA